Happy Monday, everybody. It is Monday, September 20, or I'm sorry, 28th, September 18th, 2023. Hope everybody's having a good day out there. I am Raymond Dahlman, your humble host here at the Liberty Call. And today we're going to go through what happened in the markets. Everyone's on pins and needles because of what the Fed's going to do. Their meeting is tomorrow and Wednesday. So everyone's like, well, are they going to raise rates? Are they going to freeze rates? Are they going to lower rates? I mean, that'd make a lot of people happy if they lowered rates, but I wouldn't put money on that one. I'd say it's kind of, well, my own personal belief, it's kind of 50-50. Are they going to raise rates another quarter point, or are they going to, wait and see and wait for more data and then decide at the November meeting? So we shall see. Anyways. All right. Well, I'm glad you're here. Thank you very much. If it is your first time watching Liberty Call, if you could give them some thumbs up, likes, shares, subscribes, follows, press the notification bell so you know when I go live. And let's go ahead and jump into the numbers for today. Dow Jones was up barely 0.02%, 6 points, closed at 34,624. S&P 500 was up 0.08, closed at 44,53. NASDAQ was up 0.01. Closed at 13,710. The VIX was up 1.89% today. It's currently at 1405. Canada was down 0.63. Brazil was down 0.34. And Mexico was up 0.73% for today. Over in Europe, Germany was down 1.05%. The UK was down 0.76. France was down 1.39. The Netherlands down 0.76. Spain down 0.71%. Italy down 1.07%. Switzerland down 0.96%. And Portugal down 1.24%. Russian exchanges both red today. MOEX down 0.55%, RTSI down 0.45%. And the overnights, the Nikkei in Japan was up 1.1%. Australia down 0.67%. New Zealand, let me stop. It says the 15th. So the Nikkei was not open. Last time it was open was the 15th. So let me start all over. All right. Asian markets, we're going to skip Japan. Australia was down 0.67. New Zealand was down 0.25%. Let's see. The Shanghai was up 0.26%. The Shenzhen component up 0.55. China A50 up 0.91. DJ Shanghai up 0.26. Hang Seng down 1.71%. And the Taiwan weighted down 1.32. So my error. I apologize. All righty, let's go ahead and hop into the weekly economic update for this week and see what it has to say. Stocks ended the week roughly where they began as investors digested a mixed set of new economic data. The Dow Jones Industrial Average gained 0.12%. The S&P 500 slipped 0.16%. NASDAQ fell 0.39%, and internationals or overseas stocks added 1.23%. Stocks struggle for direction. Stocks traded around the flat line without any catalyst in either direction. On Thursday, investors welcomed the European Central Bank, signaling its rate hiking campaign may be nearing its conclusion and a successful IPO that revived optimism in the capital markets. Investors also cheered a stronger than forecast retail sales report and a modest increase in core producer prices, overlooking a higher than expected headline number. Yeah, because people inflation at the core looks good. If you take out food and gas and, then inflation is nothing to worry about. But sentiment quickly reversed on Friday as a drop in consumer confidence, troubling news in the semiconductor space, and a labor strike at the nation's major automakers dented Thursday's optimism, sending major averages to a mixed close for the week. Inflation progress stalls. Surging gasoline prices drove August's inflation rate to its highest monthly rate of this year, rising 0.6%, while the year-over-year CPI posted a 3.7% increase, up from July's 3.2% annual rate. Core inflation, excluding energy and food, was more encouraging, rising 4.3%, down from July's reading of 4.7%. Producer prices also came in higher than expected, rising 0.7% in August, above the estimate of 0.4% increase and the biggest monthly gain since June of 22. The year-over-year increase was more modest. The year-over-year increase was a more modest 1.6%. Gasoline prices significantly contributed to the month's jump. Excluding food and energy, prices aligned with forecasts, ticking up 0.2% in August. Economic data this week. Tuesday, we have housing starts. Wednesday, we have the FOMC announcement, basically the Fed meeting on Wednesday. Thursday, we have jobless claims, existing home sales, and the index of leading economic indicators. Friday, the purchasing managers index composite flash. Companies reporting earnings this week. Tuesday, we have AutoZone. Wednesday, FedEx and General Mills. Thursday, Darden Restaurants. All right, so that's the weekly update. Exciting stuff, if I do say so myself. Not really. It's stuff's pretty boring, quite honestly. All righty, let's get to the market recap. S&P 500 inches higher as tech, energy, power ahead. All right, on Monday, the S&P 500 inched higher as the week commenced with optimism in the tech sector, although investor sentiment remained cautious ahead of the Federal Reserve's upcoming decision scheduled for Wednesday. Apple led the surge in big tech stocks, rising over 2% as signs of stronger demand for the newly launched iPhone 15, particularly the higher-priced Pro and Pro Max models, generated optimism. However, differing opinions emerged regarding the iPhone 15's strength. While Wedbush reported robust pre-orders, Barclays suggested a challenging cycle in China with demand favoring the lower-priced iPhone 15. Energy stocks continued their upward trajectory, having gained approximately 20% since July. This ascent was bolstered by rising oil prices, reaching the highs last seen in November of 22. The optimism stemmed from recent extensions of supply cuts by Saudi Arabia and Russia. In contrast, ARM Holdings experienced a decline of more than 5% following its strong debut in the stock market the previous week. Despite the dip, ARM's shares remained well above their IPO price of $51, having enjoyed a 25% surge during their NASDAQ debut on September 15th. In semiconductor industry, Micron Technology received a slight boost as Deutsche Bank upgraded its rating to buy from hold. The optimism stemmed from expectations of increased demand for high bandwidth memory fueled by artificial intelligence. PayPal faced pressure, declining over 1% after MoffettNathanson downgraded its rating to market perform from outperform, citing concerns about growth amid intense competition. Meanwhile, Tesla also witnessed a downturn as Goldman Sachs lowered earnings expectations due to worries that further price cuts could impact margins. Clorox saw a drop of more than 1% after warning that a cybersecurity attack last month would have a material impact on its fiscal first quarter results. Regarding Treasury yields, the 10-year Treasury yield briefly tested highs of around 4.4% before relinquishing gains. This occurred as investors awaited the Federal Reserve's two-day meeting set to commence on Tuesday, widely expected to conclude with a decision to maintain interest rates. Beyond the decision, the Fed will present fresh projections on the economic outlook, including inflation and unemployment, as well as offer guidance on the rate outlook. Recent indications of slowing inflation have raised hopes that the central bank may opt for a longer period of higher rates rather than delivering an additional hike. The market will closely monitor the projections and commentary from the Federal Reserve Chairman Jerome Powell for insights into the Fed's further course after the September meeting. Yeah, basically. That's all we can really do is just sit and wait and see what the Fed's going to do. Again, like I said at the beginning, I personally think that they should continue to raise rates. They're, in my own opinion, are not high enough. With inflation as high as it was last year, I'd hate to see a rebound effect. And right back in the same spot. So that would be unfortunate. All right, next up, I got an article from First Trust. It's titled Higher Rates and a Showdown on the Menu. That doesn't sound good. In the world of college football, the University of Colorado Buffaloes have swiftly risen from relative obscurity to a position of great prominence with their undefeated record. They're 2-0, so let's not get too excited. However, when it comes to government, standing out is rather effortless. The Federal Reserve is poised to release a statement on monetary policy this week, while Congress faces the task of passing a new budget or potentially shutting down non-essential government services by the end of the month, a situation closely monitored by investors. Now, what is a non-essential government person? Pretty much all of them. From the military to, really you could get rid of the entire thing and the average human being wouldn't even notice. Regarding the Federal Reserve's actions, there isn't much expectation of surprises. The futures market indicates a probability of less than 1% for a rate hike at the current meeting. However, what could provide a surprise is the futures market's odds of a rate hike at the December meeting. What about the October-November meeting? Come on, you're just going to skip one? Estimated around 45%, which some believe to be too low. Elevated oil prices and rising health insurance rates are expected to keep inflation high, while real GDP growth appears robust in Q3. Combining high inflation with solid economic growth doesn't suggest a prolonged pause by the Fed just yet. It's anticipated that Chairman Jerome Powell will hint at one more rate hike this year. As the Federal Reserve meeting unfolds, questions may also arise about the looming possibility of a government shutdown at the end of September. Fingers crossed. While media and investors' attention has gravitated towards this issue, historical data shows no correlation between federal shutdowns and economic performance. Shutdowns in the past, including one that lasted 35 days, did not trigger recession, and the government being closed didn't equate to economic downturn. Essentially, the government shutdown doesn't necessarily translate into a recession. It's important to note that the current budget confrontation doesn't involve the federal debt, as the debt limit has been suspended until January of 25, ensuring timely debt payments without default. Social Security and essential government functions will continue, but the government's substantial growth over the years, increasing tenfold more than the economy as a whole, is a point of concern. With record high debt and escalating entitlement costs, there's growing recognition that the current path is unsustainable. Really? Really? You think now we're unsustainable? All right. In summary, while the college football world looks at the University of Colorado Buffalo's meteoric rise, I think more of it has to do with prime time, the government's role in the economy, impending budget, but decisions and the potential for a shutdown warrant careful attention from investors, with an emphasis on the need for fiscal responsibility in the face of mounting challenges. Brian, I appreciate your hope that there's going to be fiscal responsibility out there in the world. I just don't think it's going to happen from our government, but I could be wrong. All righty. Last up, I have a video here from, where was this from? This is from Malden Economics. And the guest today is Peter Boockvar of Bleakley Advisory Group, and he's talking about soft landings and what the economy is going to do. So we'll go ahead and listen to a couple of minutes of this, and then we'll finish up. So let's go ahead and hit play.
What are you hearing? Because before we started rolling, we were talking about how there's almost a disconnect between the data that we're being served and the anecdotes, the stories that we're hearing out there. Are you hearing corporate leaders say that things are good and we're in for that mythical soft landing that we keep hearing about?
So in the aggregate, because I do want to split up the economy in different pieces here and go over certain industries and what they say, but in the aggregate, it's the belief that if the economic pain hasn't happened yet to a great extent, then maybe it's not. And I'll give an example. It was who is it? It was, I'm trying to think who the bank was who spoke at the Barclays Financial Conference yesterday. And I can't remember if it was KeyCorp or it might have been Citizens Financial maybe. It was either one of them. And they had sort of forecasted in their financial sort of budgeting and projections for this year is that by the end of the year, the unemployment rate in the US would go to 5%. You go to 5%, you're in a recession. And in the conference, the CEO actually said, you know what? We're now considering the possibility that we do have a soft landing. Because if in their eyes, well, if it hasn't happened yet and we're still under a 4 unemployment rate, it's already September, well, maybe it's not going to happen. But just because it hasn't happened doesn't mean it's not going to. So I think on the financial side, commercial industrial loan demand is tepid. And it just small, medium-sized businesses who we usually tap at are definitely seeing less visibility in their business, and therefore they're asking for less loans. If you look at the manufacturing side, the key thing that's been happening this year in manufacturing is you've had this massive inventory destocking. And there are some companies that have sort of right-sized their inventory situation, particularly big retailers like Walmart and Target, and who've talked about it in their last earnings call. And the question is how far, but then others are still experiencing excessive inventories that you're still seeing this destocking. So the question is when does that stop? And when does some restocking, rebuilds happen? Because if that rebuild happens, then manufacturing improves, transportation sector improves. And even transportation, it's somewhat mixed. Union Pacific at a conference talked about, they entered the third quarter expecting a certain level of volumes, and volumes so far have been less than that. But then J.B. Hunt, speaking at the same conference the next day, talked about some green shoots in terms of volumes. Now, this is sort of like dancing along the bottom here. The ISM manufacturing number has been below 50 for 10 months in a row. So everyone's trying to figure out is when does this destocking cycle sort of end? And maybe we're close, but what kind of rebuild we have in inventories will depend on end demand. And with respect to end demand and the consumer, if there's one clear theme, and it's not just just the quarter that just ended, it was the quarter before, is there was a clear shift in consumers prioritizing their spend, focusing more on consumables and food and grocery and drugstore and beauty, for example. Like Okta had a good quarter, but then not spending much on hard goods, electronics and jewelry, furniture, and so on. And also sort of definitely a bifurcation in the spend where lower to middle income consumers are getting more squeezed. Higher income consumers are doing much better, but they're spending on travel and entertainment and restaurants. But even they are shopping in Walmart. Doug.
All right, we'll go ahead and stop that there. And like I said, it's a really good interview. It's about 41 minutes long if you listen at normal speed. But I'd give that a listen. It is linked in the show notes. So if you want to listen to that at your own leisure, feel free to do so. But definitely some, kind of a Goldilocks or not. The Three Bears, it's not too hot, not too cold. Right now this gentleman's opinion is kind of in the middle. Just because it hasn't, like he said, just because, a hard landing or a soft landing hasn't occurred, it doesn't mean it's not going to happen 2, 3, 6 months from now. And, one thing I've learned in this business is that, just because you think something's going to happen next week, it doesn't always happen. But, if you, typically, if you think things are going to, something bad is going to happen in the future, it typically does, maybe it just doesn't always happen on schedule. You can look back at the financial crash of 2008 and 9, looking at it, the yield curve had been inverted and then it normalized, then the economy fell apart. So I depending upon what the government's doing and what, big business is doing, trying to hold everything together and keep their fingers in the dam, trying to keep the leaks from getting too bad, there comes a point where they can't do enough. And, eventually, like I've said before, it's, like the sand, the sand pit or the sand pile, it piles up and the pyramid gets higher and higher. And then eventually it just slips, and it just takes one little grain of sand to, knock everything over. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.